You do have business, you're taking business risk. You're not taking volatility risk. Looking at past betas or past volatility really will have nothing to do with future volatility.
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.
I hope it doesn't happen. I hope. I think this is one of the few places you can take a class like this. It doesn't make any sense to me. I understand the math. If you're buying a piece of a business, it's just different than, who cares what other people are paying for it at a particular time. I care about what the cash flow. Your risk is that the business turns down. The risk is that, they go from 1 million square feet to 200,000 square feet and then out of business, with $60 contribution margin for each foot. You do have business, you're taking business risk. You're not taking volatility risk, or, you're taking risk based on what is the income stream going to be, what are your coupons going to be from that investment? What are your earnings coupons going to be from that investment? That's the risk you're taking. If you understand that, and so you might want to have more than 5, you might want to go to 8 because you don't want to take that coupon risk from that business, but it has nothing to do with any of the measures, the volatility measures that are used generally to assess investments. It is true that people are influenced by those, and if you're going to be one of those people, then you want to know how volatile your business investment's going to be. Having said that, looking at past betas or past volatility really will have nothing to do with future volatility, so it's also suspect in that regard. You're making assessments that, when you're figuring out your standard deviation of your portfolio, the only good way to do that is looking backwards, which really is not that helpful, because looking forward, you're making these estimates that make the results of your portfolio construction pretty much worthless. And then, of course, who's done a cross-correlation matrix between anyone? Okay. I don't get that either. And it's very complicated stuff to do, and people do it all the time, and it's hard to do. But it's all based on assumptions, garbage in, garbage out, and I think most of the assumptions are garbage. And I'm not sure that the output that you're looking for to figure out how volatile it'll be over a 1-year period. Now, for instance, when Rich Vazina was in here, if you measured his volatility, his standard deviation over 1-year periods, okay, his standard deviation was equal to the standard deviation in the stock market, okay? So no benefit there. But if you looked at 3-year trailing periods, okay, just go 3 years, rolling periods. So you go January of 87 to January 1990, February 87 to February 90, and like that, 3-year rolling periods, then his volatility over 3-year periods was half the market. So which one should you, so everyone who does these analyses uses 12-month annualized standard deviation. Even if you want to use it, it's the wrong thing to use. Okay, it really should be using 3- and 5-year standard deviations over those kind of time frames. Then it may mean something. But even the way it's done, so I think the whole process is just, the efficient frontier and is just missing the boat, like, hugely. And I think it's taught because people have invested a lot of time learning the math. I think Haugen wrote it up. Said, it's a big investment in this theory, and it's elegant. It just makes assumptions that are completely unrealistic and, not really that worthwhile in the real world. So I guess that's what I'd say about that, and I doubt that Buffett would, or I think he specifically said that. All right, so we covered that. Wanted to make sure I mentioned once again that you can't look at EBITDA without looking at maintenance CapEx. If you want to use EBITDA like Charlie did for comparables, that's fine if it's only one metric, and there's a good explanation for why you're doing that, because the CapEx is unclear and everything else. It's just one more metric you could use, but only in a comparable sense, not an evaluation sense, because EBITDA in itself means nothing. That's not how much cash you have. You have maintenance CapEx. All right, we talked about previously Mr. Market, and Buffett's great example was the Washington Post story that he writes about, where he said, gee, at the time I bought the Washington Post for $100 a share, if you had asked any analyst on the street, what would it be sold for if it was sold today, they all came out with $400 and $500. Okay? Yet they weren't recommending it because, it didn't look good for the quarter. So I think Mr. Market does crazy things sometimes, and that's great in the short term. And what I told you in the long term is Mr. Market gets it right. Okay? There's a lot of reasons for that. Who can name some reasons why Mr. Market gets it right over the long term? Short term, we read the paper, right? We saw stocks bounce around tons. Yet, so Mr. Market's crazy, then how does he get sane over the long term?
Well, the fundamentals of business sort of reveal themselves over the long term.
I think that's the big...
Mm-hmm.
Right, I think that's the big picture answer. There may be uncertainty right now and fear or whatever there might be in the stock price, but over time, whatever those fears or issues were, resolve themselves. Now, it may take 2 or 3 years for those things to resolve themselves, but eventually they do, right? And then smart people, if it's still trading at a bargain, will buy it. People who are doing the analysis will buy it when the uncertainty is done. And that could take 2 or 3 years. It could happen in 6 months. Could happen
You shameless
in a week.
cloner. Want to track portfolios of
Generally, it
famous
happens
value
within
investors
2 to
like
3
Warren
years.
Buffett?
Almost
See their
always
buys and
within 2
sells,
to 3
current and
years.
historical
That happens.
holdings? Just visit
Another thing that could happen
valueinvesting.guru.
is,
It is
companies see the stock's
valueinvesting.guru.
cheap, they
Link
might
in the
buy it back.
description.
They may buy it back when it's overpriced, but if a company sees a stock is really cheap, they may view that as a good investment. That's another way that stock prices get pushed up to fair value. Another way would be what? Takeover or threat of takeover, right? You don't even really have to have a takeover. Just, if you buy all the shares up, that's all, you own the company. So the fact that that can happen at some time, if there's not too many takeover barriers, means that the market, eventually the stock will start trading towards what it's worth. Otherwise, someone's going to come in and do it for you, either a big company. So that's how Mr. Market gets rational over a period of time. And even statistically, if I look at it, it generally, on average, happens even in a year period. But almost always it happens within 2 to 3 years. Not always, but almost always it happens within 2 to 3 years. And that's such a powerful concept. It's like, forget the market, okay? I want to do my analysis. If there's a big enough discount, I'm going to assume that over the next 2 or 3 years I'm going to get my money. And if you just keep thinking that way, forget about anything else. It becomes a very simple process. It becomes a process of how good a valuation can I do? And if the stock's at 10 and you think the valuation range is 15 to 20, that may be close enough, depending on when you think it's going to be there. But even over 2 to 3 years, that's still a pretty good rate of return. So you might not have to pinpoint exactly what it's worth, but if you think 15 to 20, it's at 10, that's kind of interesting. One of the investments we had a number of years ago was Foot Locker, a simple investment. And there, it was a very simple story. Stock was trading at 10 times earnings. Stock was earning $1, and it was trading at 10. It hadn't grown in a bunch of years. They thought they had, opened up enough stores, and I guess that's why it was trading at 10. There was a bunch of cheap stuff out there. But we just did a little work, and they had a chain, I think it was Champs, was one of their chains, sporting goods, and basically it sold sneakers, but it was a big box store. They were losing a shirt in a number of these big box stores. And frankly, when you added it all up, they were losing 50 cents a share in these big boxes. The regular little sneaker stores did very well. That was where all the money was being made. So really, they were earning $1.50. You're getting the idea, right? They were earning $1.50 in the sneaker store, losing 50 cents in these big box stores. And over the next 3 years, all these money-losing stores were coming off lease. 1/3, 1/3, 1/3. So what you really had was $1.50 in earnings, $10 stock. We came up with a valuation of somewhere between 17 and 20. And at $10, it was kind of a no-brainer. And so, we didn't have to pinpoint the valuation or even know whether it was worth 22 or not. We had plenty of margin of safety to find that. And we didn't even have to predict the future that well. We could just assume, hey, you know, the business stays flat, which we think it's growing, but let's say assume it's flat, and we have this free money coming to us. So that's a good example of a good investment.